Okay, so we're gonna go over term sheet. So, what is a term sheet? Have you guys ever actually seen a term sheet? Or do you know what that refers to? You seen a real one? A real live one?
Yeah.
Nice. Where'd you see it?
On a investor memo for my internship
Cool.
The
Nice.
start.
Where'd you intern?
at Altalink Capital. They're
Okay.
it's a search fund with Mike Robertson here in Provo.
Oh yeah. Yeah. Nice. Okay, cool. How's he doing, by the way? Is he finding his deal yet?
He's good. We'll submit an LOI in like a week,
Nice.
so
Cool.
we'll see what happens.
Cool. So a term sheet is basically the same thing as an LOI. Who knows what an LOI is? Letter of intent. So in private equity or buyout land, people submit LOIs. In venture capital land, people submit term sheets. They're kind of separate. They're kind of two different worlds. So the question is a term sheet or an LOI a binding legal document?
Yes.
Yes, but only to a certain extent.
Yeah, in a very limited fashion. So it's yes and no. Mostly no, partly yes. Okay, so what I want us to do, everyone go to the National Venture Capital Association website. Okay. So,
Isn't there also a term sheet for debt, for people who are going to supply debt, what they're
Uh-huh.
willing to finance?
yeah,
They just have the same name for,
yeah.
that's what I'd seen. I haven't seen
Yeah, I mean, they're equivalent terms, it's just what's used more. In venture capital land, no one says the word LOI. Like if you say, I submitted an LOI to consider, people are like, what?
Okay.
Right? You know, and the same thing, if you're in private equity buyouts, they're like, oh, I submitted a term sheet. They're like, wait, what? What?
Got it.
You mean an LOI? You're like, oh, yeah. Okay, so on this site, if you go over here to, shoot, where is it? Resources, right here, there's a little thing that says Model Legal Documents. You guys see this link? You're gonna wanna remember this, or find this stuff. Click on Model Legal Documents under the Resources link. Okay, as you scroll down, they have all these sample legal documents that come as part of a venture capital financing. Right? And this is awesome. I mean, you guys can run a lot from this, but we'll focus on the term sheet, which is largely a summary of summary of the key terms from all the other documents. So go ahead and download that and then open that up together.
Justin, is there a PowerPoint like slides you'll send out to, besides like the tips for PowerPoint?
That's not really focusing on class.
Right.
So what I typically in the end, when I started teaching this class, it was anticipated that you guys were doing more work outside of class, but you're not getting class credit for it. Realistic.
Yeah.
So I started just with the last class, doing like an hour on PowerPoint, just basics, like really rudimentary stuff. It's not going to blow your mind, but if you've used it at all in the past, it's more just about elements of a presentation versus a pitch book, right? How do you structure it right? How do you copy and paste Excel and do some cool things with Excel? So it's really focused about transporting the model in, PowerPoint, and just some basics of plugging it in.
Okay.
So you're using it, and here's some quick, easy ways to structure things so that they work well. So it's very basic. But could be helpful. Depends on where you're coming from. All right, so this is what they call a model term sheet. So this sample document is the work product of a national coalition of attorneys who specialize in venture capital financings, and working under the auspices of the NVCA. It's intended to serve as a starting point only and should be tailored to meet your needs. What's nice about this document is it gives you alternatives for the key terms. Like what's the menu essentially for the key terms, which is super helpful. So this is incredibly educational, so we're going to go through it together. It's the best way to learn venture capital, just going through this right here. Term sheet. All right, so we'll start with this first page and go through this. We'll spend about an hour doing this, and the last 2 hours building our little VC model. So, Series A preferred stock financing is the title. What does Series A mean?
They're the most senior.
No. It's from a bank.
First round.
Okay,
It
close.
would be in
Yeah.
the beginning. I mean,
It's
but it's a
really
specific kind of first round. But
First type.
yeah,
of
it's the
stock
first
issued.
institutional round.
Yeah.
Okay? So there'll be friends and family, you might have a seed or angel round before this. You might have 2 or 3 rounds of financing until you actually do your Series A. Your Series A is like our real first round of money from a real venture capital firm, right? That's what a Series A is. And then the next round they call the Series B, C, D, E, F. Now, I built and ran a valuation company, Scalar Analytics, and I must have reviewed 100 term sheets from VCs doing that, so we had to go through all the term sheets. And we would see the terms and the structure from multiple rounds of financing. There was one company we valued, and most of the easy part of our work was comps, DCF, and that was easy. The hard part of our job was deciphering the cap table from all these rounds of venture financing. It was incredibly complex because we had to figure out the waterfall. Figuring out how much the company was worth was super easy. The company's worth $100 million, right? But figuring out how much of that $100 million goes to the Series C shareholders, the Series B, the Series A, and the common stock, which is usually what we needed to value, that was incredibly difficult. And so we would have to go through and decipher these term sheets to figure them out. And so I saw many, many different structures. One company was a Series H company that had the nastiest terms I have ever seen in a term sheet in my life. It was, wow. Way up, way beyond what you guys we're going to talk about in this one. So, Series A, right? First institutional round. So then it says preferred stock. What's preferred stock?
Just like non-voting, it's more like debt than equity, but it's considered equity.
Yes.
You get paid first though in the case of like liquidation and stuff.
Yeah, so the first important thing for you guys to understand is that there are lots of different kinds of preferred stock. Okay? So yes, what you refer to is what I would call traditional preferred stock. It's a debt/equity-like structure. Traditional preferred stock has a dividend, which is the same thing as an interest rate. And it has a redemption, which is the same thing as maturity, or maturing. So it just has different terms. It's still considered equity, but you pay dividends, and then it's redeemed, right, at a certain date. That's traditional preferred. VCs, venture capitalists, use a security known as convertible preferred. Just like convertible debt, they have preferred stock that's convertible into common. Okay? And of that, we'll get into some different variations of that convertible preferred. There's different types that we'll get into in the liquidation preference section. So yes, it's important that you understand the security they're investing in. That's really the magic of VC work. It's how they protect their downside, because they get paid first in a liquidation, right? That's how they make sure they get their money back in the event things go wrong. Okay, let's read this first paragraph. The term sheet summarizes the principal terms of this blah, 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 blah. Inc., a Delaware corporation. How presumptuous. How presumptuous. I mean, what's wrong with Utah? What's wrong with California? Isn't that where most of the venture capital firms are based? In
California.
Silicon Valley? I mean, why Delaware? What's up with that? What's up with that, dog?
It's the first state.
First date, yeah. Okay. So, gosh, when I was coming through the MBA program a decade ago, wow. What they used to say is VCs required every single company to be a Delaware C Corp. Before you can do your Series A, you have to be a Delaware C Corp. Otherwise, they simply will not invest in your company. So there are rules, it's called the Investment Company 40 Act. There are legal and tax differences between operating companies and investment companies. And so LPs in a venture capital fund cannot get past their income. That's why you need to be a C Corp. There has to be a taxation event on the income. It's what they call a C blocker entity, a C Corp. So you have to be a Delaware C Corp. Why Delaware though? Why would they require it in Delaware? Any idea?
Delaware is more favorable litigation for businesses and investors.
Yeah, for whatever reason, I'm not sure how it started or how it became this way, Delaware is the venue of choice for businesses for a couple of reasons. The main one is predictability, legal predictability. So Delaware has an entire court system that only adjudicates corporate law. That's it. No family law, no real estate, well, real estate's business, but all they do is corporate law. That's it. It's called the Court of Chancery. When I was at BYU, I was on a team that we went out and competed, and we won the Delaware corporate law case competition. So beat out a lot of top law schools in the process. It's pretty fun. We got to actually argue our final round in front of Delaware Supreme Court judges, which is pretty cool. So we were like citing these cases that these guys had decided, and we were like, oh, that's kind of cool. My buddy got a job offer at the end of it. It was awesome. We went and worked for him for like 10 years. Yeah.
Do you still have to be a C Corp?
Yeah.
Yeah.
Yeah, you gotta be C Corp. But they've loosened up. I guess some VCs are now getting more comfortable like investing in Utah entities, but that's the exception, not the norm. You need to be a Delaware. The reason it's Delaware is because they have all this case law, all this court history. So when something happens and there's a legal dispute, the lawyers can go and check all this case law. And there's a very high chance that the fact set you're dealing with now has already been tried and decided. And there's a legal outcome you can rely on to offer predictability to handling that legal dispute. Whereas if you're incorporated in Utah and you have a legal dispute, you take it to the Utah courts, right? Utah courts, court cases, relatively speaking, could probably fill one chair in this room, whereas Delaware case law would fill every single chair in this room, right? And so you take it to court in Utah, you don't know what's going to happen, right? We have no idea how the Utah judges are going to read this thing because there's no precedence for this situation. The judge, it's a wild card. The judge can decide. You can wake up on the wrong side of the bed and rule against us. Yeah.
Yeah, so to classify then as a Delaware C corporation, like, does that mean they just have to start in Delaware, or?
So basically your law firm can do it all for you.
Uh-huh.
There's what they call a registered agent.
Right.
So there's little companies that do it. They basically just receive your mail in Delaware and forward it to you.
Okay.
Honestly, like that's it.
So you don't actually have to operate out of Delaware. You just have to.
Nope. You just have to incorporate there for it's weird. Yeah. Like my Horizon View Capital, my entity is a Delaware LLC. My lawyers, that's what you gotta do. Okay. And when I sign NDAs, the template NDA I send out, I put the venue is Delaware. That's kind of the neutral place to go. If you're dealing with a company in Texas and a company in New York, right? Well, we want New York law. We want Texas law. Okay, let's go to a neutral venue, Delaware. Okay, so that's where you go. All right, in consideration of the time and expense devoted, blah, 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 the no-shop/confidentiality and potentially, that's why it's in brackets, counsel and expenses provisions of this term sheet shall be binding obligations of the company, whether or not the financing is consummated. So that is the only binding portion of this term sheet in a venture capital deal, is the no-shop. Meaning, If you sign this term sheet, you can't talk to other investors. It's just you and me. Right? You can't go out and shop our deal. You can't say, hey, I got a term sheet with a 10 million pre-money, anyone want to beat it, anyone want to beat it, here's the terms. Can't do it. Right? If someone else offers you a term sheet out of the blue, that's different. You didn't shop it, right? So you can't go out and solicit other offers when you sign after you signed our term sheet. Okay? That's really the only binding paragraph. Okay. No other legally binding obligations will be created until the final legal docs are executed and delivered. This term sheet is not a commitment to invest and is conditional on the completion of due diligence, legal review, and documentation that's satisfactory to us, the investors. This term sheet shall be governed in all respects by, let's see, footnote 1. Choices of law governing a term sheet can be important because blah, 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 blah. Okay, you can read that if you want. All right, so here's some of the key terms. Boom, out of the gates. Closing date, when is it? All right, investors. Investor number 1. How many shares are they getting? What percentage are they getting? How much capital are they investing? 2 of these 3 numbers matter. 1 really doesn't. Which 2 numbers matter?
Percentage and amount.
Yeah, shares is an arbitrary number. Right? I can create a company tonight and authorize and issue 1 trillion shares to myself. I can do that. Absolutely do that.
Penny stocks.
Yeah. Whereas Warren Buffett, right, his company is worth, billions and billions of dollars, and yet does he split his stock? What does it cost to buy a single share?
A few $100,000.
It's like 100 and
Yeah, it's like, a couple $100,000 to buy a single share of a stock, right? So he could care less. So the shares is a completely arbitrary number. Now listen, it will eventually matter. If you intend to do an IPO, your share count number will begin to matter. Why?
You can change it though, like
You
even
can't
after
change it.
this. So
It's an arbitrary number. You can authorize new ones, you can do stock splits, right? You can do reverse stock splits. You can do all kinds of stuff with your shares to get the number where you want it. It's all legal maneuvers, but it has to be approved by board minutes and blah 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 blah. The reason is that if you guys have ever tracked IPOs, they all seem to price within the same dollar per share range. Has anyone ever noticed that before?
Yeah.
Most of them price between $15 to $20 a share. Why? Why would the investment banks do that?
Consistency. I don't know.
I don't know. It's an okay number. It's enough above 5 to where it's, I don't know.
So what happens if your stock trades down to $1 or below? What if you IPO at 5 and the stock trades down? Anyone seen Vivint Solar? Where's their stock at?
260 something now maybe?
Where'd they IPO at?
16? Yeah, I bought in like a couple weeks ago when they hit like 2. So
Okay. So, what happens if their stock trades down to $1 and it stays there for a long time?
they have a time limit before they have to delist, don't they?
That's exactly right.
Break the buck.
Yeah.
Right.
So yeah, you trade long enough, NASDAQ will kick you off their exchange.
$2 minimum.
Yeah, kick you off, and now you're an OTC stock, right? And that's a problem that hurts your liquidity, hurts your brand. So investment banks like to price you at 15 to 20, so you have enough of a cushion that you avoid that delisting risk, but low enough that retail stock investors can buy your stock, right? Right, Bob can say, I want to put $100 into that stock, right? You can buy 5 shares, right? $20 a pop. So that's what they like to price it. So eventually, if you do get down to that IPO path as the entrepreneur, you will be somewhat concerned with the share count as you approach that IPO. Okay. Amount raised, this gives you the total amount, but I want to focus on this little paragraph at the end. So, the total amount raised, let's say it's $5 million. Do I have pens today? Let me see, I'm going to do, yes. You guys all see this over here? Alright, so we're going to do a make-believe round. Alright, we're gonna say we've got, let's put, okay, $4 million investment at an $8 million pre-money valuation. Okay? Alright, so it says, okay, we raised $4 million, including $1 million from the conversion of principal and interest on bridge notes. What the heck is that? What the heck are they talking about?
Would that just be if they run out of their current, I don't know, amount of money and they need
Bridge notes? What's that?
something to get them, before they can get their actual money from this round of investing if they're out?
Yeah, it's convertible debt. This has become a very popular thing to do. I think 10 years ago it didn't happen a whole lot, but now it's like everyone's getting convertible notes. All these startups. Okay, and what it is basically an investor comes across a small young company that I think is super promising, very cool. Wow, this is going to be huge. We want to get in. Hey, we want to invest in your business. Oh, we're not raising our Series A right now. We're not going to raise our Series A for another year. But I am a little nervous on making payroll next month. It would be nice to have like $500K to get us to next year until we're ready to raise our Series A. Why would the company not just want to take the money right away? Guy's like, I want to invest $3 million. Let's do it today. If you're a young company just barely getting going, why wouldn't you want to take all that money right away?
Yeah,
I mean, if they
all
wanna,
expectations right away.
build up your value a little bit more before you get your Series A.
Yeah, valuation is the problem, right? It's like, hey, we got to get like our product out in the market. We got to get some beta clients. We got to prove some things. We got to hit some milestones. Got to create some value, because if we take the $3 million now, right? Take the $3 million now, our pre-money is going to be $4 million. If we wait 12 months, if we hit these milestones, we can raise at an $8 million valuation. What is the difference to the founder's ownership?
25% or 5.
Yeah, that's like a huge chunk of the business. So no, I don't want to do $3 million right now. Well, the investor says, oh man, I really want to get in this business. So what they do is say, okay, fine. Then how about we just give you $1 million in convertible notes? And the entrepreneur says, sweet. And what the convertible notes say, so it's debt. So we'll give you a loan for $1 million at 8% interest. The interest just adds to the balance, right? So it just accrues over that 12-month period. So it's a 1,080,000, what is it, right? 1,080,000, something like that.
Yeah.
But there's also a discount. So that investor will get some benefit at the round. So the convertible notes, the debt will convert into preferred shares at whatever the Series A ends up being, whatever valuation it ends up being. So you may come out and you may raise $4 million at a $20 million pre, right? And you haven't been hurt by taking that $1 million, right? You have given a discount though to them. So they put in $1 million, but they're going to get 1.1 worth of preferred, right? So they do get a benefit for going early. So there's a discount, the interest just accrues and adds to the balance, and then it converts at whatever valuation your Series A ends up being. So you don't suffer the dilution, and you can wait for that valuation, that money to kick in and dilute you. So it buys you time to create value and prevent dilution. But smart investors will put a valuation cap. They say, we'll give you a convertible note, but our note converts to equity at a valuation not higher than $10 million pre. Right? Like if you raised a $20 million pre, our $1 million is rolling over at $10 million pre, and everybody else is at 20. So they can, right? They can eat it, but that's what we're doing.
And they set those terms. Like if it's over 10 million, they'll say like we get this much.
That's it, it caps. So that's
So
the cap, basically,
So
our
what if the,
investment is capped out.
so what if the what if the company does raise it 20 million?
Then the $1 million converts at at a lower valuation. They get more shares for their investment.
So is that the discount then, or is the discount like per share
They get a discount plus
plus?
the cap.
Okay.
So the $1 million, so they get 1.1, so the discount's 10%. They get $1.1 million worth of preferred shares at a valuation of X, right? 10 million means they have a lower dollar per share, so they're getting more shares for the dollars they put in from the other guys.
Okay.
So they're getting in $1 a share, the other guys are getting a 2. Okay. So that's how the notes work. That's very, very common nowadays. You guys start a young company, you should expect, angel investors to offer you convertible notes. Like, it'll happen. Okay. And then the price per share is arbitrary, just depends on the number of shares you have. Pre-money valuation. Okay. So there's a few things investors can do to mess with your pre-money valuation if you're not seasoned. All right. And one of the things is with the option pool. So they can say, the original purchase price is based on a fully diluted pre-money valuation of X and a fully diluted post-money valuation of Y, including an employee pool, option pool, representing X% of the fully diluted post-money capitalization. So the option pool can be included. The investors can stipulate that you create an option pool of a certain size, but the dilution from that can be calculated on a pre-money or a post-money basis. Okay, so how does that work? Kind of like this. So these guys say, okay, it's 4 over 3, right? So the post-money is 12 million. One of the things you guys need to keep straight is this all still jives with our equity value, enterprise value math. Okay? So if we say the pre-money valuation is 8 million, what we're saying is your, gosh, this pen doesn't work great, Jim, darn it. One. Need a good one. All right, I'll just use a spreadsheet, that's fine. I'll just use a spreadsheet. Okay. All right, Series A investment, let's go pre-money. $8 million. So let's say founder 1, right? We have founder 2. Then we have the Series A investors. Actually, we'll put the founders below Series A. Then we have the option pool. Okay, so before the deal, right, it was just you and me, man. It was just you and me. Partners, right? So we owned 100% of this bad boy. All right, and then the investors came in and said, oh, in the term sheet, you need to put in a 15% option pool. You're like, oh, okay, on a pre-money basis, what they say. So now, you guys have to go, okay, equals that times 1 minus that. So we just got diluted and no money got put into our company. Free money. Okay? So now, in terms of the equity value and enterprise value, so when you say $8 million pre-money, what you're saying is, this down here, this, what I'm about to teach you is completely lost on venture capitalists. I have no idea. Okay? Enterprise value is $8 million. Okay? Your net debt, let's say it's 0. You have no cash, no debt. Right? So your equity value is 8 million. Right? So post money, they put in $4 million.
Yeah, of convertible debt.
I'll make it. This is just, let's just say it's just $4 million investment. Right? So we're actually going to make this equal to, it's our enterprise value minus our net debt. So what's our post money? The only difference is cash, right? Our enterprise value hasn't changed. We just have the value of our enterprise plus $4 million in the balance sheet. And that's what we that's where, so you're talking about pre and post money, you're talking about equity value. What's lost, and I've seen this happen before, is that sometimes companies do have debt. Very rare, most venture-backed companies have no debt, right? They just do with all equity. But when they do, the VCs are lost. They don't know how to deal with it. I've seen this happen. One time I was brought in to do a valuation of a company, and it was backed by some reputable venture capital investors and private equity folks in Utah, who shall go unnamed. But they did a deal with debt, and they had no idea about this basic enterprise value to equity value calculation. And I had to deliver the terrible news. You guys may have heard the story before, but I delivered the terrible news to these guys that your enterprise value was $12 million, but your equity value was like -20. And they were like, wait, what? And I was like, okay, let me explain what enterprise to equity value is and the concept of net debt. And I'm like, yeah, your business is only worth like $15 million, but you have $40 million of debt on your balance sheet. Right? Like, well, yeah. I'm like, yeah. Yeah. You built an asset you spent $40 million building an asset that's only worth 15. That's basically what I'm telling you. And so, it's lost on people. So don't lose track of that. Okay, don't lose track of that. All right, but that's what happens when that comes in. Now the Series A comes in, okay, and they say, all right, so we're going to take, what's our ownership percentage? Right, so the post money basically is equal to the pre plus the investment round. Right? And so their ownership percentage is equal to this divided by the post money. So taking a third of the business. Okay, so these guys are coming in, Series A, taking a third. The option pool is 15%. And then you guys, right here, 1 minus that, and 1 minus that. That's what you take. So you've gone from 50% all the way down to 26. You've gotten completely destroyed. That makes sense?
Can you do that again?
So all you gotta do is you gotta think, okay, we each own the business 50-50.
Right.
We gave 33% to the investors. At a pre-money valuation of 8, if they put in 4 more, they put in $4 million, and our post-money valuation is 12. Under this math right here, they just put cash in the balance sheet, right?
Mm-hmm.
So they own a third of the business.
Right.
33%.
Right.
They mandated that we also create a 15% option pool. And that is input on a pre-money basis.
Okay.
Okay, so that dilution doesn't affect them. The dilution of the option pool doesn't affect their ownership. That's what they mean by putting it in pre-money.
Okay. Yeah.
If they put it in post-money, it looks like this. They invest, third. We're all thirds. Now the option pool dilutes us all equally if we put the option pool in post-money or after the investment. So now, take everyone's percentage times 1 minus the option pool. Right? Do you see the difference there?
Yeah.
So by putting the option pool in pre-money, it dilutes the founders only,
Mhm.
not the investors. By putting the option pool in post-money, it dilutes the investors and the founders. The founders have more ownership. Remember how they were at 26% or something before? Now they're 33. So it's a very subtle thing, right? But if you don't pay attention to it, that's 5% of the business, 10% between the two founders, right? So those are the subtle things to look for in a term sheet, right? That will affect your valuation.
So who has claim on the option pool?
It's used to recruit and retain, and hire, and used to retain and recruit future employees. This is a young startup company. You've got to try to recruit people from big companies to come work for the small company. You've got to give them options. You know, you've got to tell them we're going to make them rich. You know, you were working at Amazon, and you had no ownership, right? The company's huge. What did you own? Like 0.0000001% of the business? Come here, you're going 2%. And then we go public at $1 billion. Right? You're pretty happy. Okay? So that's the pitch. And so you have to have an option pool to make those key hires. All right, does that all make sense? Okay. All right. So that's that. Okay, next steps. Now we're going to talk about the economic rights that these preferred investors get. These are your different options. Dividends. Alternative 1, 2, and 3. Dividends will be paid on the Series A preferred on an as-converted basis. When, as, and if paid on the common stock. What that means is, if the board decides, hey, we had great cash flow, which never happens in a VC deal, right? We had great cash flow. We think we should issue a dividend. Give it to the shareholders. Well, the preferreds, all they're saying is, hey, if the board decides to do a dividend, we get some too. You can't leave us out. That's all it says. Okay, that's very entrepreneur friendly. Alternative 2 says, the Series A preferred will carry an 8% cumulative dividend payable upon a liquidation or redemption. For any other dividends or distributions, participation with common stock on an as-converted basis. So what this means, cumulative dividends means whether you know it or not, you are paying us an 8% dividend every single year. It doesn't have to be in cash. So our $4 million investment is accruing 8% every year. It's getting bigger and bigger every year. Okay? That makes sense? You don't have to pay cash, but our $4 million balance increases by 8% compounding every year. So that's a cumulative dividend. And so when you sell, you have to pay, and then we'll get into the liquidation preference, this will make more sense, but, so that's one option. The next one is non-cumulative, but if you do issue a dividend, you have to pay us this much. That's what this says. Alternative 3. Usually most VC deals is alternative 1. Right? They don't want to burden the company with the dividend issue. In buyout private equity deals, it's alternative 2. Right? We're going to pay out an X% dividend, right, and really crank this thing out. Okay, in the event of any liquidation, dissolution, or winding up of the company, the proceeds shall be paid as follows. Alternative 1, non-participating preferred stock. First pay 1 times the original purchase price plus accrued dividends. So this is the 3 options you have in terms of the preferred. You can have non-participating, full participating, or a cap on participation rights. So what the heck are you talking about? So this is the very key part of the preferred security. A liquidation preference. In the event of a sale of a company, basically, the proceeds shall be paid as follows. First, pay 1, 1.5, 2, 3, whatever you want to negotiate. What's normal? 1x. That's what's normal. First pay 1 times the original purchase price, basically saying if the company sells, okay, if down the road the company sells for, let's call it $15 million, okay, we get our $4 million back first. And then we'll distribute the 11 million that's left according to everyone's percentage. Oh, sorry. Okay, this will be helpful. So this one says non-participating. So first pay 1 times our purchase price plus any accrued dividends. So if you have a cumulative 8% dividend, you're getting 4 million plus 8% a year compounded. Okay, if you don't have the cumulative, if it's alternative 1, then it's just the 4 million. Or if greater, the amount the Series A preferred will receive on an as-converted basis. So non-participating preferred, the investors have to choose. We can either take $4 million and get our money back and walk away, or we can take 4.2 million, right, and take our share of the deal, our 28%. We have to choose. Either we get our money back at 1x, or we take our percentage. We convert to common. That's their choice, one or the other. Okay, participating preferred, which is the next one, is worded differently. It says, first, pay 1 times the original purchase price plus our accrued dividends. Thereafter, doesn't say or, thereafter the preferred participates with the common on an as-converted. We get to do both. We get to do both. Look what happens to the founder's share if it's full participating. So the investor gets 4 million plus 28% of whatever's left. The investors get $7 million bucks. New founders get 3. That's full participating preferred. They get the money back first and their percentage. You get both. Double dip. That make sense? I'm going to do the option pool on a pre-money basis. That's normal. There you go. Investors are getting 7.6 million. You're getting 2.8. You and your partner. Okay, but if they don't have participation rights, they get 5, you get 3.8. So obviously, easy to tell which one's better for the entrepreneur, right? The next alternative is that you say, okay, listen, you want participation rights, I get it, but let's put a cap on that. Let's put some limits, some guardrails around that. So first, pay 1 times the original purchase price plus dividends. Then we participate on an as-converted basis until the holders of the Series A receive an aggregate of 3 times. That's the normal cap. 3 times the original purchase price. Saying you can double dip, but only up to a 3x. If you double dip and it results in more than 3 times your investment, then you have to choose. You have to choose. You're either going to double dip and cap out at 3x, that's all you get is 3 times your money, or you have to convert and just take your percentage. Which one do you want to do? Okay.
Wouldn't
So-
you just want to, couldn't you, wouldn't the choice be easy? Wouldn't everybody just get their 3 times? Because then with that,
Well, no,
if
they
they
don't
wanted,
they
they could
get
go.
their money back plus their percentage,
Right,
up to 3x.
right.
So if doing both results in more than a 3x, you have to give up that extra piece. That goes back to the founders.
Okay, gotcha.
So you might be a situation where you get your money back plus your percentage is like 4.5x.
Okay.
but if you just take your percentage, it's 2.8. And then you have to choose. You'll say, okay, we'll take our money back and our percentage, but we're capped out at 3x. And then the remaining amount we would have had gets resprinkled to the option pool and the other founders. So it's a way for the founders to get a little bit more back from those guys, right? Saying you can only participate up to 3x return. After that, you have to just convert to a common, so we get more if we have a really good outcome. Okay. All right, so that's a very important part of the term sheet. That's a very important part of the security. Is the dividends and the preferences is the economic rights. You know, one time I was doing an evaluation of a company, and the CFO. This was a mature company. I mean, they had, I don't know, 15, 20 million in EBITDA. They were venture capital backed in the day. It was kind of older, maturing technology. And then a private equity firm had come and bought the business out. And the private equity firm had participating preferred with cumulative dividends at 8% a year. And they gave me their projections, and their projections were flat. There's hardly any increase in EBITDA over the 5-year period. And so I did the valuation work. I came back to him, and I showed him what the Series A would get and what the management team would get if they sold the business. Year 1, year 2, year 3, year 4, year 5. And he said, why is our founders' money going down each year? And I said, oh, that's an easy answer. Your investors have cumulative dividends. He's like, what do you mean? I'm like, I mean, they get 8% of the equity every year gets added to their balance. And your company, you're not growing the equity value greater than 8% each year. So they're just grabbing a piece of the equity every year, taking it away from you guys. Because you're not growing fast enough in your projections. He's like, oh, crap. It was the first time that his light had clicked on what that meant. This poor CFO, they agreed to a deal, and he really didn't understand it. I was like, crap, so every year my share of the equity is going down? I'm like, yes, it is. Sorry. Need to break it to you.
So at that point, because it's like contractual, is there nothing he could do about it?
What could he do?
For the company.
Yeah. Grow the equity value faster than 8% a year.
But, so do they, like when you enter into these terms,
Yeah,
it's
locked.
not for,
No.
okay.
Oh, yeah. You're not gonna, hey, can we change that? Right.
But I thought you
Deal
said
is
like
done.
these were only somewhat legally binding.
Oh, yeah, term sheet is.
Right.
This was after everything was documented and
Uh-huh.
money was wired, right? So, this was after the fact.
So this becomes legally binding at a point, like once.
No, the term sheet's not binding. So yeah, you can sign a term sheet and then you can go and evaluate it and realize what it means, and you can walk away.
To
You can
what
walk away
point?
from the term sheet. You can say, hey, listen, we really didn't understand what we were signing. We did our homework. We understand the terms now a little better. We don't like them.
Just
So,
peace out.
yeah, this is non-binding
So
document.
is it once you take money, that's when it's,
What's that?
so is it once you take money from them?
Yeah, so you sign a term sheet, they go into due diligence, then you draft all the legal docs. And so all of this is then documented in all these other documents.
Okay, gotcha.
So these are just snippets of the terms. They're all explained in much greater detail in these documents that we see right here. Certificate of incorporation, investor rights agreement,
Stock purchase.
stock purchase agreement, yeah, this voting agreements, right? So all these terms in this term sheet are more, spelled out in more detail in this legal doc package, which the lawyers go back and forth on.
Okay.
You say that the only actually like binding thing from the term sheet then was the confidentiality, like,
That's exactly
no
right.
shop.
Yep. But
So-
yeah, once you like, hey, no deal, we're gonna walk.
Right.
No, then okay, tear it up. Who cares?
If all of those were signed and the term sheet, would that matter or no?
All these documents?
Yeah.
Yeah. Usually what they do to BC deals is everyone will sign all the documents, and once all the documents are signed, boom, they wire money. It's a done deal now. No going back.
And between wiring and all of them being signed, though, you can still rip it up? Or not? Before the
Yes,
wire
if
gets
you
there?
sign the term sheet, it's gonna be 30 days before
Okay.
you get your money, right? And you actually have to sign all the legal docs. So yeah, but before you sign the real docs, the binding docs, these are all the binding documents.
Binding docs, okay.
Right? Before you sign those, you can walk. But once you sign, you're done. Right?
Yeah.
That's an ironclad deal.
Thanks.
Okay, what else? All right. Voting rights, this is important. So even though we're only selling, in our hypothetical scenario, 33% of the business to the investors, do we really have control? Do they have control, or do we have control? Who has control?
If it's just like normal standard preferred, you would still, right? 'Cause
We own a majority, right?
Yeah, well, yeah.
Between the two founders.
We own 52%. This is our business. Nope. Voting rights. This is who controls. Ignore the percentages. What's the board structure? That's where control is determined. This is how they do it. The board can be 3 or 5 seats. In the seed stage deal, might be 3 seats. In a post-Series A, they might expand the board to 5. And what happens is, they will give, if it's a 3-seat board, 1 seat goes to the investor, 1 seat goes to the CEO, and then the 3rd seat is an independent tiebreaker. That make sense? Who can go one way or the other. Doesn't have an economic interest in the deal, is more just an advisor. If it's a 5-person board, 2 seats to the investors, 2 seats to the company, and then 1 independent tiebreaker.
How do you decide on that?
Yeah, who's the tiebreaker?
So let's read here. Series A preferred shall vote together with the common stock on an as converted basis, blah, blah, blah. The Series A preferred as a class shall be entitled to elect blank members of the board, 1 or 2. And as required by law, the company will provide the number of authorized shares. So it'll also say something like, and the board will be comprised of 2 members to the investors, 2 to the company, and a 5th member to be selected by could be the company or the investors, who's mutually agreeable. So both sides have to agree to that person, that 3rd or 5th person. Right? So both sides, one will recommend a name, and the other side has to agree to it. So both have to agree on that person, right? So that they're both comfortable. Because that person's the tiebreaker.
So then that board has controlling interest for what happens?
Well, it just prevents either side from having control,
Okay.
right? And letting that 3rd person, because they're independent, right? They're just going to kind of be the arbitrator, essentially, right? They're going to decide, hey, listen, I hear you, founders, but listen, the Series A guys, in this situation, they're right. I'm voting with them. This is the right thing to do, right? Or, hey, sorry, investors, I'm voting with the founders on this one. They're right. It's not fair what you're trying to pull on them, so I'm voting with the founders. That's kind of the role that person should play, right? It's doing the right thing because they don't have an agenda. That's why they're independent. Okay, so that's where control is. Another part of control is these protective provisions. These say, in addition to any other voter approval required of the company's bylaws, the company will not, without the written consent of at least 50% of the Series A. So basically what this means is the Series A, the new investors, have a veto right. The company cannot do any of the following actions without approval of us, the investors. That's what that says. And here's the actions they cannot do without our approval. Not the board, just us, the investors. We can veto it by ourselves. Liquidate, dissolve, or wind up the affairs of the company. Can't close or sell the business without, we can veto it. If you and the independent want to do it, we can say no. And it's done. And it's no. You can't amend or alter any provisions of the certificate of incorporation. You can't create or authorize or issue any other shares. or convertible securities. You can't purchase or pay any dividends. You can't take on any debt, right? You can't blah, 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 right? Increase or decrease the size of the board, right? So these are very critical things that the veto rights apply to. The investors can block any of these actions.
This can be edited though, right?
No? It can be negotiated.
Yeah.
It can be negotiated. Series A preferred initially converts 1-to-1 to common stock, blah, 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 blah. That might be different. I've seen that before where it's 1 to 1.25. So they actually convert at a higher rate into common. But that's pretty rare. Pretty rare. In the event the company issues additional securities, blah, blah, anti-dilution. So in the event we buy stock in the Series A at $2 a share, then the Series B gets done at $1.50 a share. Right? Now we get diluted. We have anti-dilution provisions to protect us. So you'll have to issue us more shares in case you do a down round. Exactly how many depends on alternative 1, what they call the weighted average, or alternative 2, the full ratchet. And alternative 3 is no protection. So a full ratchet says, I don't care if in the next round, right? I don't care if in the next round you give 50% ownership to somebody else. A full ratchet says you're going to issue us more shares so that we stay right at 33%. So who eats the rest?
Just the founders, not the option.
Oops. That's not right. Oh, that is. That's what a full ratchet does to the founders like that. Bang!
So the option pool does change.
Yeah.
Okay.
Unless the Series B investors
Anti-dilution option pool provision.
stipulate we have to have a 10% option pool. Now, you're down to 4%. Right now, you're really down. Would investors drive the founders all the way down to 1% or less? Would that be advisable for the investors to do that?
No.
Why not?
Since the founder won't even come to work.
Exactly. I don't care anymore. So it's not in the investor's best interest to beat them up that bad.
Bad enough to where, yeah, as low as
So-
they can get it without you walking away.
Yeah, I mean, so what'll happen sometimes though is if the deal does go south and you need money to survive, right? And the Series A has a full ratchet on you, the investors will say, okay, listen, I know you guys are getting absolutely body slammed here in this round, but this option pool, we're gonna give those to you guys. We're gonna give a big chunk of those to you guys to keep your ownership up.
Depends though, if it's like $50 million and that, if you have 4% of Facebook, then you'd be like, oh, I'll probably hang out, still.
Yeah, well, they were giving up a much less percentage for lots of dollars, so.
Yeah.
They're raising money at very high valuations, so they're okay. But yeah, if you have 4% of a huge company, no big deal, but if this was a $10 million pre-money, you have 4% of a $10 million business, you're like, that sucks. But that's how a full ratchet goes, is it ignores that. A weighted average is it's like you would go to like 25. You wouldn't be fully diluted, but you'd be diluted halfway. So it's some protection. That's normal as a weighted average. Full ratchet, that's nasty, that's mean. Very rare. So if you see a term sheet from an investor that has fully participating preferred and a full ratchet, run for the hills, man. Run away. It's a shark.
Why would people accept that then?
Desperation, lack of alternatives, lack of education. Okay. They didn't take this class. Right? Alright. Mandatory conversion. If there's an IPO above a certain valuation, all the preferred has to convert to common. That's a requirement. Pay to play, okay. So this is to deal with future down round scenarios. So if a new investor comes in and he says, listen, I want to invest in the deal, but the deal has lost value, and the economic rights of the Series A investors are really getting in the way of the deal. They don't have any money to invest. This company's dead unless we come in. So we're gonna do a pay to play clause, which means if a certain percentage of the Series A, if they don't invest with us in this round, anyone who doesn't have money to put into the deal, we're going to force them to turn into common stock. We're going to wipe out all of their economic rights from prior deals. So investors can lose all the rights they negotiated in a prior deal. You can lose your board seat, right? So all shares of Series A failing to do so to invest in this round will automatically lose anti-dilution rights, lose the right to participate in future rounds, and convert to common stock, and lose the right to a board seat if applicable.
This is
So you
only
could-
in down round scenarios?
This is called a pay to play, so it's basically saying, listen, we're recapping the company. We're redoing the cap table. That's our offer. You don't like it, go find money from somebody else. But that's our requirement. This deal, the economically doesn't make sense with those terms from the Series A for us. Right? So we're going to get rid of them. The only way they can retain them is if they invest with us in this round. But if they're out of money, then they're screwed. That's why venture capitalists will reserve money, what they call dry powder. So they'll invest $4 million, but if that's all the money they have to put in the deal, they're in a really risky spot in case this happens, right? The company has a small hiccup. It took them a year longer than they thought to develop their product, and they ran out of money, and they have no progress, no financial progress to show for it. You're screwed, right? Now the new investors can come in and you have no leverage. You have no money to put into it. You're done. So good VCs will always reserve money, right, that they can keep and continue to invest so they can protect their rights. Okay? All right, redemption rights, blah, blah, blah. So you can stipulate that, hey, at some point, we want you to be able to buy us out. Like if it's 7 years and there's still like no progress, nothing's happening, you just put the money in the bank and stare at it for 7 years, then we're gonna put in a redemption right where we can put our stuff back and you have to buy us out of the deal to get our money back, basically. So this is another
Makes the company buy.
company buy, yep, give them the cash back, provide cash back to the investors and cash them out. So they can stipulate the price, the terms, you can stipulate a multiple, you can buy us out at a fair market valuation, 6 times EBITDA, or 2x our investment, you know, whatever you want to negotiate. Okay? And so then here's other terms for the other agreements. So for the stock purchase agreement, reps and warranties, conditions to closing, investor rights agreement, registration rights, piggyback, lockups. If we do an IPO, you're locked up for 180 days. You can't sell any of your stock for 6 months when you do an IPO. Okay? You have to agree to that before because that's required. Right to participate in future rounds. So I have a right, a first right of refusal. If there's a Series B, we get to lead it, right? We get to invest in it before anyone else does because we're an existing investor. All these things require direct approval, all these actions, non-competes, board matters, right of issue of co-sale. If somebody sells their shares in the company, we have a right to include and have our shares sold too. You can't sell your shares without giving us the same access to sell our shares too in that same deal. Right? So you can't just go off on your own and sell your shares at $5 a share and not include us in that sale. That's the right of co-sale, or take me along. drag along. Hey, if 80% of the shareholders vote in favor of selling the business at X price, you cannot disagree with us. By contract, you will agree if we get 80% of the vote.
Is age just an arbitrary number you put out there?
Yeah, I kind of am. There's 50% or more of the voting power is transferred and approved. So they say 50% here.
So is that 50% or more of the voting power as in the board?
Yeah. Yep. So you will agree, you will be forced to vote in favor of it if the board votes in favor of it. That's basically what that means. So you can't come back and file a lawsuit against us saying, we didn't agree to this, right? We didn't consent to this sale. Yeah, you did. You signed a drag-along provision in the investor rights agreement. Sorry. You have no claim. Right? Deal's done. All right. There you have it. Helpful? Educational? Good. Now should we model out a venture deal? Let's do it. Okay. So go back here to your inputs page. All right. So here on our capital table inputs page, we're going to model out, down below here, we're going to model out an angel case or a seed round. And then up here, we're going to model a Series A investment. Okay, so we're going to say, what do we want to do for the angel case? We're going to say, what if we get a deal like A? What if we get a deal like B? What if we get a deal like C? What's the impact on our ownership and on our exit value, right? And then we're going to say, what about our Series A? What if our Series A looks like this, or like that? What's the impact? And then we're going to test that against our projections and our exit assumptions to see what's the impact of these terms and changes in terms and deal structure. Okay, so what we're going to do is this is cap table 1 is more of a cap table for presentation purposes. It kind of nicely lays out number of shares, price per share, invested capital, percentage ownership by round. There's a founders round, there's an angel round, and there's a Series A round. Okay? So we're going to model that out there. That's going to be nice. We can present that in the board meeting and people can see it and understand it round by round. And there's going to be another version here, which is going to be year by year. And this is going to match and jive with our projections that we're going to create. Okay, which will be year by year. So we're just going to start at the cap table. Okay, let's start with the founders round. Okay, so let's say we say, all right, hey, we just formed our new business. Let's issue 2 million shares. Let's issue those bad boys at a penny each. That means I'm going to put in 10,000, you're going to put in 10,000. Okie doke. That means us founders, we own, look at that, 100%. Yeah! Eureka! All right? Why would you want to do that? Why would you want to do a founders round? I mean, who cares, right? The company's worth nothing anyway. Why would you want to actually put money in and get shares back? What would be the purpose financially? Financial motivation to do that?
You know, just establish yourself as a founder officially. I don't know.
Okay.
I mean, if, like for tax purposes, there's probably some
Yes.
benefits than if you were to just like use your credit card as when you're still small. So
Well, the tax, you got to think about begin with the end in mind.
Okay.
There's 2 types of tax. Your tax is classified in 2 different ways. Income tax or capital gains. If you're Mark Zuckerberg and your founder stock is worth, what, like 100 billion or something ridiculous? what tax rate do you wanna pay on that? When you actually liquidate your position and turn it into cash? Do you wanna pay 40% tax on it? Or 20% tax on your founder shares? So do you want your shares to be issued to you as compensation? Or as a capital investment? That make sense? So it's advisable to do this. Even if it's like, well, I got $20. I got $20, right? Do it now. Do it when your company is nothing but a piece of paper. Do it right away. Put some money in and say, my shares are an investment. Right? I invested money. I bought those shares in the company. So when I sell them, 5 years later, that's a return on capital gains tax applies. Okay, there's other things and rules that lawyers can do. Even if you do get issued shares, they can convert it and it's like an 83B election and all this mumbo jumbo. But this is a real safe way to do it. Okay, so now we set up the shares, all right. The money we pour in early on to get the thing going, you know, it has some basis legally. Okay, so we get that going. Okay, let's set up our assumptions for the angel round. So let's go back here to our inputs tab. Okay, so our angel round, let's say, okay, upside case. Do you want to do this from the perspective, do you guys want to be a VC or do you want to be an entrepreneur? What do you want to be today?
Let's be entrepreneurs today.
Entrepreneurs?
Yeah.
All right, cool. Entrepreneurs. So from an entrepreneur's perspective, the upside case is we get lots of money and we give up very little equity. Right? That's a good thing. So we'll say we'll give up 20% and we get 1.5 million. Actually, let's go 15, 20, 25. Okay, so downside case, we only get $500,000 and we have to give up 25% of the business. Option pool. Upside cases, they only require a 10% option pool, 15 and 20. So the upside case, we're only giving up 25% between the option pool and the investors. Downside case, it's 40%. Security type. Is it fully participating? Is it non-participating or participating with a cap? So I'm going to change these up a little bit. Let's call these fully participating, non-participating, participating, the cap. FPNPPC. Non-participating, participating with the cap, and fully participating. So we can create little codes like this and then use those in our model and say if this, then that. Probably won't do it today. So quick caveat is that creating a model that can account for all the different scenarios and term sheets is actually incredibly difficult. I hope I can illustrate a little bit of that. There's just a lot of circularity that you have to model. And hopefully you'll begin to understand that as we build out the model. Honestly, modeling cap tables can actually be one of the most complex exercises in finances. It can be, once you start doing the math on it, you realize like, oh my gosh, wow, like there's all these iterations. The Series C can do this or that, and the Series B can do this or that, and then proceeds go like this and then that, and it's just crazy complicated. Okay, liquidation preference, 1x, 1.5, 2x. When do final start?
Friday.
Tomorrow is the official start date.
Today's a
Uh,
reading day. Tomorrow's reading day.
Oh, reading day Monday. One of your class does it early. Okay, dividend type, non-cumulative, non-cumulative, and cumulative. Dividend rate, 6%, 7%, 8%. Anti-dilution, weighted average, well, let's go none. Weighted average, full ratchet.
Sounds so violent. Full ratchet.
It does. It is violent, trust me. Economically violent. All right. So let's get to it. Let's get to our cap table. You guys have those in there? Everything look okay?
Mhm.
Okay. So now we'll come over here to the angel round. And model this in here.
Before you do that, the liquidation preference is just how much you get back on your money right there. The 1x, 1.5x.
Yes. Yep, so first pay 1, 1.5, or 2 times our investment amount. And then, depends on the security type.
Alright, okay.
All right, so here the founder's shares are unchanged. Angel round are just equal to the prior round. Share number is unchanged. All right, percentage ownership, we already kind of know what this is. So we said we were going to give up 15% ownership. They're going to invest 1. Whoops, I'm doing the wrong thing. Should equal, that should equal, make sure you're doing this column. That column, 20%. $1 million. Then do the option pool percentage, which is that number. That's all we need to figure out our cap table. That's all we need. So we're going to say equals. Parentheses. Equals prior round total shares divided by 1 minus that minus that. So we're basically saying $2 million divided by 65%. So dividing it by 65% basically means 2 million shares is equal to 65% of the shares. And by dividing it by 0.65, we're going to actually get the new total. So then we're going to take that new total, which is between those parentheses, and multiply it by our 20%. And that tells us how many shares the Series A gets. Now, we're going to want to do the same thing for the option pool. So let's think quickly about what we need to anchor. So I'm going to click right behind F19 and tap F4 twice. Tap F4 twice there, and there. Once I do that, I should be able to copy and paste. I can copy that percentage. Place it there. And that should all equal 100%.
Did you anchor all the percentages?
What's that?
Did you anchor all the percentages? Or which ones again?
Everything except for that last number right there. So there's the equation.
Is it that same formula for the option pool?
Yeah, it's the same formula. I just copied it, pasted it. Okay, let's calculate our price per share. There is our post money.
What was that one again in I-13?
This one?
Thanks.
Okay. All right. Awesome. That's it. Okay, now we'll move on to our Series A round. Let's go back up here. We'll put up some assumptions up here. Now let's actually stress test that real quickly. Just to make sure our dollars and percentages are working. Let's go to our usual case and run the upside case. Put 1 in there, hit enter. And go check on the cap table. It's good. Price changed. Valuation changed, right? Now it's a $10 million post money. We still own 75% of this business. Killing it. Crushing it. Let's go to the downside case. Okay. $2 million post money. Yikes. We went from 100% to 55% in one fell swoop. Boom. That's painful. Let's go back to our base case. Okay, now let's move up to this Series A. All right, let's say upside case, we give up 20%, base is 25, downside 30%. You guys want to take 5 minutes?
Go for it.
Hey, Jack. Good, how are you? Yeah.
Yeah. minus. So just copy that right there. No, go up, yeah. Yeah, just- Okay, I got it. You get everything else? Yeah, it is. So, do you think, right, so this one is, back here, let's do equals. For invested capital. Go there, equals. And then go to the capital inputs. And go just right here. Invested capital. So, the reason you want to reference this one is because this just builds off of whatever you input here. What's in blue, right, is hard coded. So that's just kind of like, so green is our linked cells, blue is hard coded.
Did you like this one?
No, this just equals that. What is that, 15? Yeah. And then percentage ownership for the founders. Yeah. It's just gonna that'll go down. That's for angel investors. It's just shares outstanding.
Right here.
Yeah. Divided by total shares. So that's 3.
Did you have, yeah, 160?
Mhm.
Did you have the same formula?
Yeah.
He didn't link anything in the founder journal, did he? To the other page? Yeah, I was like, I didn't see anything.
So you just yeah, there you go. Just gonna go over.
Thank you.
No problem. How's Jack doing?
Is that
How's Jack?
Jack? Jack is back.
Nice.
Back in black.
Yeah.
Jack Black.
How's your search fund going?
Oh man, it's an adventure. It's a total adventure. I don't even know where it's going, to be honest, right now. I'm like so like got like all these opportunities swirling. I don't know what I'm doing.
Search for
What?
search for what?
I'm doing a search fund.
Oh,
That's
okay.
called.
Gotcha.
That's what they're called, but I'm searching for a business to buy that can build and grow.
And by the way, my buddy and I are working on. Yeah, it's a.
You need to have at least $1 million to $2 million.
No, we just have a prototype of that. It's for like financial advisors, and it's like a risk calculator basically, but just using modern portfolio theory.
Cool.
$20 million is yours, just like that. No questions asked.
Hey, finally. All right, I'm back.
It's cruise.
All right. Okay. Okay, invested capital, let's say $4 million. Bang. We do 3. We do 2. Option pool, they stipulate 10%, 15, and 20. I'm going to copy the exact same things down here. Copy them, Control C, paste them up there. Okay. So now we'll take that, we'll go back to our cap table, model this in here. Now we're on the Series A line up here. So we'll model in Series A percentage, 25% of it right there. Invested capital, 3 million. Carry over our Series A shares. Carry over our founder shares. But we will need to recalculate the option pool. So that will be the option pool percentage of 15%. Okay. So what we're going to do here is we're going to say equals parentheses equals the sum of those two numbers. Those two numbers divided by parentheses 1 minus that number minus that number. Right parentheses, right parentheses should give me a new total shares number. Multiply the total shares times 25% right there, 11. And that should give me my Series A shares. But I tap F4 to fix the row on some of these inputs here. So there, there, and there.
So you fix all the inner ones and you leave the outside one, right?
Yeah. See the party over there?
Yeah, I think so.
You just copy and paste that 615.
I copied pasted this one.
So what was it you did there to get those other percentages?
I just copied that formula. Pasted it there as well.
Okay.
And then I just always check it. I just always do that and make sure it adds up to 100%. So make sure my math is right. Which it does. Equals sum of all of those. So we do that so that can be covered and checked. If this doesn't equal 100%, then you know your calculation's off somehow.
So what should that be? Let's say P13. What's the actual numbers that should be in there?
This one?
Let's see. Yeah. Okay. Okay. Yeah, it worked now. Okay. Thanks.
So this is what will happen is the Series A guys will say they'll refresh the option pool. Meaning we want you to keep it at 15%, so increase the option pool. That's why we had to kind of recalculate it. Or they could just leave it the same, so it'll be a smaller percentage and the shares of the option pool stay the same. That's up to the investor to dictate. Okay, last thing we should calculate price per share. So we raised at $1.63 in the angel round, and now at $2.75 in the A round. Got a post-money valuation of $12 million, and we have 46% of it. We're millionaires. So valuation does not equal value. Okay, so there we go. That's kind of our presentation cap table, right? And if you want to, you can include stuff down here, like revenue multiple, how many new shares were issued, post-money valuation, which we kind of have there, and what the revenue multiple was, but we're not going to worry about that too much. We'll focus on the next slide. I'm getting things done for that. So I'm actually going to skip cap table 2. Let's just go straight to our VC returns tab. And we're going to do some updating. So right here where it says 2008, type over that 2015. And then to the left of it, make it equal to 2015 minus 1. To the right, make it equal to 2015 plus 1. That way our year columns are more dynamic. You just need to update the most recent year and then all the other ones will calculate. Alright, let's say, I'm going to make this up on the fly here and we'll see how the numbers shake out. Let's say we do $500,000 in 2014. We did 1.5 million in 2015. We got 200% growth in 2016. 150% growth in 2017. 100% growth in 2018. 50% growth and 30% growth. Alright. And we'll say, okay, well, that was our revenue, but what was our EBITDA? What kind of operating losses did? What was our net burn rate here? And we're going to say, oh, shoot, man. What am I saying that one? Let's have this be, this is our 20 grand we put into the business in the first year. Here we're going to say we burn through $1 million. Right, burn through $1 million. Here we burn through $2 million. That's our net burn, right? So our actual operating expenses are that minus revenue. So operating expenses are 1.5 million, 3.5 million there. Let's say we had CapEx is light in tech companies. We'll say this is a tech company. It's really just computers and furniture and random stuff like that. Xboxes for the programmers and the bullpen. Party wagon. I don't know whatever else you have. know one company, Neil, has like an RV, they take the trade shows and stuff, bunch of crazy stuff. Let's say it's 500,000. Without an office space, it's $1 million. Alright, EBITDA here is negative 100%. Here it's negative 150%. No, that seems a little crazy. Let's go maybe 75%. Here it's negative 35%. Break even 20%. Actually, let's go 10% there. Alright. CapEx is light, let's just go $1 million a year. So rule of thumb, anytime you're dealing with millions, you don't need a decimal place, right? That's just noise. I'm gonna take this one, it's 30 seconds. Hey Jack. Yeah, yeah. Yeah, that's fine. Yeah, find a replacement. Yep. Okay. Let me talk. I'm waiting on one other thing. Can I get back to you kind of tomorrow morning-ish? That okay? Yeah. Yep. Yeah. Monday's good. But Tuesday night is a question mark. So let me chat and see where we're at there. Okay. Okay. Thanks. Bye. All right. So there we go. There's our burn rate down there, right? There's our cash flow. Now let's see if this is a little high. We're gonna make this like negative 20%. There we go. Now this is what you want to do, right? As a startup company, what you're worried about. How much money do we need to raise? How much dilution are we going to take on raising all this money, right? How much are we going to burn? Of course, this is all unknown, right? I mean, this is super tough to figure out. But, if you do enough research, you do enough homework, you can start to see, what's the path of other similar types of companies in our space, right? And what kind of burn rates, what kind of capital raises have they made? Because, we shouldn't expect our outcome to be too different. So if you can do that kind of homework, I'm just getting rid of the decimal places because we're dealing with such big numbers. Decimal places are good when you're doing millions, and it's like 1.0 million or 1.3 million. But when you're actually spelling it out this way in actual dollars, don't really need the decimal points.
What's the shortcut that you did on that? Just Command 1 or something?
If you have so the people who started with us at the beginning will have this pre-formatted here, all 4 and 5. You probably won't.
Oh yeah.
So it's Alt H, O, 0, and 9.
Okay.
So it's Alt, I think it's Alt 9, Alt H 9. Alt H 0. Yeah, Alt H 9. Okay, awesome. So now we can say, okay, what about our capital investment? So we had our founders round, which is misspelled, it's Founders. No automatic spell check in Excel. Okay, founders round, yeah, we raised 20,000 bucks right there. Put that there. Angel round, right?
There's usually plugins.
No, I don't, if you
Yeah.
drive back and stay the night, that might actually work better. Okay. Okay, great, that might work actually, so, let me, well, hopefully we can do tomorrow morning. All right, awesome, thanks, Jeff. All right. Okay, now we're gonna make stuff up. We're gonna say, what about a series B? Okay, we're just gonna say, okay, let's say it's 5 million and then it's 10 million. Those need to be blue. We have a hard code in there. Alt 2, or it's Alt HFC. And that gives you a color menu. You then select the color. Okay, so there we go. Do we have enough? Does that give us enough cash? No. No, look, we're even short there, aren't we? We got to either reduce our burn projection or increase our capital raise. Let's reduce our burn for now. So EBITDA negative 500,000 minus a million. That gives us a little bit of surplus. We're still short in the out years. So let's make the B round. 10 million. And the other one, 15. You want a little extra cash. You want a margin. That's a little cushion. Ooh, I don't know, that's a lot of money. That's a cushion. That's okay. Take it. So there's kind of a financing estimate, right? So now you're thinking, wow, it's a lot of money we need to raise. How much dilution are we going to take on that, right? Well, we shall see. We shall see. Okay. Next, what we're going to do is we're going to say, all right, what about our exit? Well, in this industry, we're in the software industry, 4 times revenue is the normal valuation. I'm just going to put 4 in right there. Okay, so we have a financing plan that gives us enough cash, more than enough cash. Let's do that. Let's do 12 million. Why would you not want to raise too much money?
Just
That's
gotta
too obvious to answer.
pay it all back.
It's dilution, right? The more money you raise, the more diluted your equity stake gets. So you want to cut that close. Cut that close. Turn cash flow positive and get your way out of there. All right, that means more dilution. All right, we're saying no debt balance, this is all equity. There's our equity value. So now we're going to say, okay, what about liquidation preferences? Okay? What are these liquidation preferences going to be? Let's hard code in a 1, and then we'll pull from our venture capital inputs tab, cap table inputs. Series A, liquidation preference of 1.5x. And an angel assumption of 1.5x. I'm going to copy this format here, Control C. And then paste that format there, Alt EST.
Where did you take it from?
Wait, what was that?
I'll show you.
Copy.
Okay, so I want to get this 1.0x format, right? I already have it back here. So I'm going to copy that. Control C.
Okay.
Come back here, highlight those 4 numbers and hit Alt EST. Paste special format. Okay. That way I just paste the format and then I change the colors and I'm rolling. Okay, so now we need to model. We can go the easy route and model fully participating, which is easier to model. Or we can go the more complicated route and model non-participating preferred. Which one do you guys want to do? We kind of need to do one or the other.
What's the most common?
Non-participating.
Let's do that one.
Okay. So it'll be a little more complicated,
All right.
but that's okay. All right. So we'll do this in steps, and then we'll have to come back and add if-thens and things like that. All right, so liquidation preference. Let's go here. So starting with Series C, they don't really kick in until 2017. That's when they invest. So we'll go to this 2017 column for them and say equals liquidation preference. Anchor the column by tapping F4 3 times. So 1x times your invested capital, 12 million for the Series C. Get rid of the decimal point. Alright. Now we can just copy that formula and paste it.
Just the row is anchored there, right?
Yep,
Okay.
column's anchored, so we should be fine. The row is relative.
Okay.
Well, actually, let's, now that we have those in there, what I should also do is to go back in and anchor both row and column there. Now we can just go Control R. Copy right, Control R.
So you did the same with that one as well. You anchored that.
Yep. Tap F2, and then tap F4, and it double anchors that invested capital number up there. Control R. So this is what's known as our liquidation preference stack. I just created a subtotal.
So can you go to that first 1.5 million? You anchored the row and the column.
Yeah, I did. But then I went and redid it for each of the other 4. So it doesn't really work. Once you anchor that row and column, now you can't really copy and paste that. But I can go to each one like this. And enter go F2, F4, enter Control right. Okay, now down here, I want to fix this calculation to not run off those numbers. I want this to just run off the equity value minus the total liquidation preferences there at the bottom. Okay, now we introduce the complexity.
So what did you do just there? Sorry.
Okay, sorry, so this
Before.
is equal to equity value. Instead of having it be minus the sum of all those, I just said minus that subtotal number.
Okay.
So what we have to model in here is some decision-making logic. For each class of security, that depends on the decision that the class before it makes. So, for example, let's just do this. Okay. Okay, so after the series A, in this column, you want to put series A has 25% right there.
Where did you pull that one from?
That's from this first kind of table. And then pulling the angel amount in that round. 14%. Rounders. 46%. Option pool. 15%. Equals the sum of all of those, even the B and the C, which aren't there yet. It's 100%. Okay. Now we have to model in the dilution from that B and C round. So we're going to say, okay, let's say the B, they invested $10 million. Let's just, give 15%. Just hard code that. And then we'll give series C 10%.
So I have the same equity values after preferences up until the last one.
This one?
No, the equity value after preferences, sorry. Yeah, so I have them all the same except for that last one.
Is this the same number?
Nope.
Did you change this from 15 to 12?
Let's see. Yes.
Did you change this to 20%?
Yep. Okay, that's a positive 10% on that end? Okay, there we go. Sweet.
Okay. Alright, so now we need to calculate our dilution, which is equal to 1 minus that. Tap F4 twice, fix the row, times percentage to the left. Alright. You guys okay? Am I going too fast?
And then you can just hit Control D when you're on
Yeah.
that cell, right? And it'll do it all.
You gotta highlight the area you want it to be.
The top
down
one.
and hit Control D. Now we gotta redo that here. equals 1 minus 10%. Fix the row times percentage to your left. Control V. Bang, there we go. Alright. Again, where it gets complicated. Alright. Not just yet, but very close. So now everything to the right, just make it equal to the number to the left. We're good. Right? From here out, the cap table stack. So it's just equal that number to the left. Make it black, and I'm just going to hit Control R. Okay, we're good. Okay, and then down below, here we go. There's this is the total returns, assuming this was fully participating. So this was a fully all of them were fully participating securities, we'd be done. Right, so this says 10% times the equity value after preferences is, 2.5 million, plus their liquidation preference of 12, so their total return is 14.5. Okay, but we said we want to measure. Let's do this though. Return on invested. Alright, so that's fully participating, right? They get the liquidation preference and their share of the value after preferences. If it's non-participating, however, we have a very different job. So, we're going to insert a bunch of rows right here. Okay, so I'm going to hit Alt HIR and then tap F4. Do it like 30 times. All right. Which style to do this?
Quick question on the column L. So I just didn't fix the right row or something. Whatever I needed to fix there.
Right here? This?
Yeah.
So you have to kind of redo it. Put a dollar sign in front of that. Right there.
67. I think. Yeah, I'm getting 95% at the bottom, but let's see. 10%, so 1.
Maybe the problem is over here. All right, so now we're going to do, you okay?
Yeah, we'll just figure it out after.
Okay.
Click there. So I've got the same thing there.
That's all the same?
Yeah, where it gets messed up is in that column somewhere.
You need to be doing it off that.
What's that?
K67.
No
This is
dollar
off.
signs here.
This is off 67, not 66. This is the.
This
second
one's
one.
also 66. Is that what you're saying?
No, I'm saying. See how he has off L67 and then K68. Or are you just?
I've
in
got
that
them
row?
flip-flopped
That's
or
why.
something.
Now you're good there.
don't know. Look at later. Mm.
Alright, so now what we're gonna do is we're gonna calculate the returns, assuming full conversion, assuming 100% conversion. So we're gonna say, well, yeah, let's do that, okay? So we'll go pro rata full conversion. What do I mean by full conversion? I mean everybody participates in this. Now, if it's non-participating, remember, they have to decide. They have to take either the liquidation preference or their percentage. They cannot do both. So, we have to calculate, right? If the Series C doesn't take their liquidation preference, right? What is their pro rata? So here we're going to say, okay, just make it equal to all those names. I'm just going to go down the option like that. And we're just merely going to say, okay, equal Series C, which is nothing really. What we're just doing it makes it easy if you copy down, copy right. Equal 0 times equity value. And we're going to do the equity value before preferences. This means, let's assume that no one takes a liquidation preference. What's their full percentage? We want you to know what that number is. And then anchor the row. Okay? And that needs to be a dollar value. Copy that from there. Paste it there. And now I know, if everybody skips their liquidation preference, this is the value they'll get. Right? That equals my equity value before liquidation preferences. Okay, good. So now I have something to compare against. I can compare my liquidation value against my full percentage of the equity value, assuming no liquidation preferences. So now I'm going to say adjusted ownership. Did you guys get that okay? Did I go through that too fast? This right here?
Yeah, let's see.
It's just, once you get that, it's just copy down, copy right. Right? Just the percentage times total equity before preferences. Which in that case is 0. They're not, they haven't invested yet in that year. So adjusted ownership, now we're going to recalculate percentages based on the if-then decision these guys have to make. Okay, which goes like this. Equals if. You know, yeah, let's just start down on the series B. Those actual numbers. Equals if. Okay, for the series B, if the liquidation preference of $10 million is greater than the Series B pro rata of 3.5 million, comma, then 0% ownership. They're going to take their liquidation preference, right? What would you rather have, 10 million or 3.5? Easy choice. 10. If that's true, then that 15% needs to get taken off. And the other guys get a bigger percent of the value after preferences. Catch my drift? Okay? Good. So there we go. And now we can do the same for the other guys. Down to the angels. Oh, that didn't work. Oh, I didn't finish the equation. Whoops. Okay? If it's not greater than, then have this equal their percentage. Right, parentheses. We're saying it doesn't add to 100%. That's okay. That's okay. Because what we can do is we can say their percent divided by this, and that will put them back on 100% scale. Now we should be able to just copy that. Right. So now we can see. See, look, all the way out in this year, everybody's skipping a liquidation preference. Everybody's skipping it. Right? Everyone's deciding to take their share of the money and forego the liquidation preferences. But what about this year when the Series B and the Series C take their liquidation preferences, but the Series A and the angel investors skip their liquidation preferences? Does that change the math? We only have 2 out of the 4 liquidation preferences kicking in. And we have different percentages flowing. So we almost need an adjusted liquidation preference waterfall now. Don't we? Told you this was complicated. Isn't it?
Mm-hmm.
Kind of like, once you start getting into it, you start to realize, you're like, oh wait, so if they do this and they don't, it changes all the math. It changes all the math based on what the Series C does. And if the Series B does something, that changes all the math for everybody else. And so what each class does changes the math all the way around. So it's very complicated. So, for example, equals if this is equal to 0, then equal the valuation preference. If not, then 0. Copy and paste the format. So who's taking their liquidation preference in that year? Only the Series B. Right? Because for the Series A guys, their choice is take $5 million or 4.5. So they're going to skip the preference and take their share. Now what will blow your mind is that they're not taking, this $5 million, this number's gonna change. Because this is 5 million of what? Or this is 21% of what? Value before preferences. So now since it's the B is the only one participating with the preference, we have to take 21%. Well, actually, no, it's not 21%, is it? It's actually, let's see, just to show you, 21% divided by 85. Because the B is taking their preference, their shares are out. So these guys now have 25%, right, of 23.5 minus 10. You see what I'm saying?
It's a pain to have to do that for every freaking one. Jeez.
Yeah, so the math is super tricky. It's like, so what the Series B does depends on what the Series C does. Right? And so I'll try to capture that here and show you what we're doing here. So what we do now is we're saying, okay, our adjusted liquidation preference is 10 million. So now our adjusted value after preference is equal to 22 million minus that adjusted preference number and then we'll say, okay, adjusted pro rata so that I already used up all 30 of those rows. Add much more. Now our adjusted pro rata is equal to this percentage divided by the adjusted subtotal times the value of the preferences. Tab F4 twice. Now I'll show you again how the logic, oh, come on. Oh, I gotta fix that. I hope to show you something here. Okay. So now that the Series B is taking its preference off, the Series A is taking 25% of 13 million, which on an adjusted basis is only 3.37 now, because of the decision the Series B made. So the Series A is deciding, do I take 3.3 million, or do I take my preference of 4.5? Did you see how the math just changed? So it's very wicked, right? All these logical loops in here. So now what we have to do is do this again. Are they going to participate now? No, the Series A, because of what the Series B decided, right? If Series B decided to take its pro rata, then Series A would take its pro rata.
Why did Series B decide first?
Because they came in last, so they're senior.
Okay.
So the last one's in, so the first one out, right? And the last shall be first, and the first shall be last. Okay? That's how it works. Is the Series C gets it depends. It can be negotiated. So when the Series C issues its term sheet, it can say, we get our liquidation preference out first.
Right.
Then the Series B gets their liquidation preference out, and then the A.
Unless there was
So
already
either
some
B then A, or they can
term in
say,
the other term sheets from when the other series did their stuff that says you can't have another series coming in, and
yeah,
diluting our.
Exactly. Or they can say, all the preferred will participate pro rata in their preferences. Meaning if there's not enough to get everybody their full liquidation preference, then we'll divide it up evenly between C, B, and A. That's a very friendly term sheet for the prior round investors.
Would it be helpful also to like, maybe even like map out that whole decision process, like, I mean, putting those numbers right next to each other, because we're comparing that with another number up there, aren't we? Like those decisions, so, I don't know, is there like another table that you put those values in after?
Yeah, you just have to keep layering, basically, right? You have to keep kind of layering and layering. So it's easy to do, so what I've done in the past when I've modeled this, is I've done it as, here's the series C decision tree.
Right, okay.
And then boom, I recalculate and say, okay, now here's the series A decision tree. They're deciding between this and that. And
Almost
then
like a
boom.
flow chart.
Yeah, exactly. And so but it causes you to just create these, like I said, this is one of the most complex things that you will ever tackle in finance.
Yeah.
So, yeah, it's really challenging. There's just no easy way to do it.
Right.
When it's non-participating, because they have that either or decision. Fully participating, it's easy. You get both. Boom, boom, right? We modeled it in 2 seconds. But this is usually what it is in venture capital lending. And so, what we have to somehow do is say, in here, right, somehow create something that says, so right there, on the series A, we're going to add an if. If liquidation preference is greater than their adjusted return, comma, then 0. If not, then our percentage. See how I layered a second if in the if true, if false section of it? So this should equal 0 now. But that will trip this out. This may blow up. It doesn't. Let me test it. See, they should be participating right now.
Can you go back to the adjusted liquidation preference? Just right there.
That's not going to work, what I just did. Okay, which one?
Adjusted liquidation preference? Yeah, right there. So that's 0.
You good? Can you show go back anymore, or is it kind of like
That's okay.
too deep, too deep?
Yeah.
Okay, so what we'd have to do here, like I said, we have to keep going if then, right? So if I go back up here, try to layer it back up in here, it creates a circular loop that gets confused. So we'd have to relayer. We'd almost have to redo this for every, so here, this makes the Series B decision. Series B decision is just fine, right? they're gonna make that decision regardless of what everyone else does, because they're first in line. But the Series A decision now, right, is 3.3 or 4.5. Right, and clearly they'll take the 4.5, but we'd have to recalculate this. This is how it just gets so wicked insane. We have to almost add another layer down here. And say, okay, so the Series A then decides, right? So we'd say, okay, if this is greater than that, 0. If not, then equal your percentage. So kind of again, we have to recalculate.
So you're recalculating because B took out their shares, and so you now have to readjust the percentages.
Exactly.
Is that B?
Yeah, because now we have an adjusted pro rata.
Yeah.
Pro rata before, up here, assume full conversion, everybody converts.
Mm-hmm.
But because of what Series B did, we have to recalculate this. Series A is not getting 4.9 because B is not converting, they're taking their preference. So now when I recalculate that right there, right, now I have to recalculate those liquidation preferences, which is the same math, which is equal to if this equals 0, then equal liquidation preference. Just in number format. Oh, and if not, 0.
So like the situation the company is in right now is they just got bought or sold, and B took their preference, and now we just have to figure out each of these now.
Yep, so now it's the Series A decision, right? Whereas up here, the adjusted ownership, Series B decision. So now Series A says, oh, well that just changed everything. Well, B, if you're gonna take your preference, then we are too. Because it pushes our pro rata below 4.5. And so that, okay, so now we're out, right? And so now we'll say, okay, what's the adjusted pro rata Series A decision? So okay, equals the percentage divided by the new total. In parentheses. Times the what's the value after preferences. So now it's equity value 3.5 minus 14.5. So now the adjusted pro rata guys say, okay, well, take our percentage divided by that times this new value after.
Did we start with C or did we start with B making the decision?
We started with B because C isn't in the game yet. And so now you see how the angel investors went from getting In a full conversion scenario, they were gonna get 2.8. When the B took their preference, they get 1.9. Now that the A took their preference, they're only getting 1.7. So now the angel has a decision. Do we take our 1.7 or our liquidation preference of 1.5? They're going to take it, so we're good. Right, we're going to model their decision. They're going to take that. And so from there, right now I can model total returns. And so yeah, we want to add in a Series C decision, right, in between there for the next years. But do you see how it iterates?
Yeah.
Between preference and percentage and values. Complicated, isn't it?
Mhm.
So like whenever, what's the best way, I guess, like when this actually happens, you just have it cascading down like each time, like they do this, here are the options, here are the percentages, here are the, you know, everything.
Yeah.
They do this just like kind of like how we're doing.
The hard thing about it is it's hard to do sensitivity analysis.
Okay.
The easiest way to do it is if I have one like transaction value, I'm good. And I have the concrete term sheets, I can go through it and model through it. Right? But if you're trying to build a model that will like calculate for any kind of term sheet, any kind of term, fully participating or non-participating, and different preference values and different exit values, it's just the realm of possibilities is so huge, and these calculations are so iterative. I mean, I'm telling you, man, it is absolute bear to calculate. Absolute bear. This would take days. Days and days and days to model. It can be done. I know it can be. I know it can be done. I've come close with some of the models that I've done in past and practice, but I haven't completed the loop. And even then, you will only get about 80% of all the possible term sheets, because on that Series H deal I was telling you about, we valued, the IRR preference was not 1x, 2x, or 3x. The liquidation preference. The liquidation preference was a 25% IRR. Basically, the guys who came in the last round said, we get paid as much money as we need to get a 25% IRR first, before anybody else sees a dime.
Wow.
So it wasn't like a clean 1x or 2x. It was, you had to back into what value equals a 25% IRR. Right? And that's the liquidation preference. And then, I mean, it was insane.
So if you could write a program to do this, you'd make a lot of money.
That's what Capture is. So the old company, evaluation company I ran, that was my guy who ran it, he spun it off, and he's trying to develop software to do this. The only problem is that the addressable market isn't very big.
Really?
No, I mean, like,
Which means you'd have to charge a lot for it, right?
yeah,
For it to be,
yeah,
okay.
it makes sense economically.
Right.
But firms must use these like financial models all the time, right?
You'd be surprised. You'd be very, very surprised.
Really?
Yeah.
So
A lot
they
of
don't.
them, I mean, when I was working at Mercado, like, we did a merger with another, we took one of our portfolio companies that was not doing hot, and they merged with another venture capital backed company. We had these venture attorneys on the deal, and they went, and the deal was like done. I reviewed everything before, but there was something that was missed, like a small detail. We had a convertible note that said, if something happened, we get 2 times our note value. The lawyer missed it, and I noticed it the day after we closed the deal. And I said, hey, there's a mistake here. We didn't get as much shares as we're supposed to get in that deal. And it was like, the lawyer had egg on his face because he missed a term at the key doc, and the financing didn't have it in the cap table model, so we were getting shortchanged the number of shares we were supposed to get relative to the others in the deal. so you brought it up, and we went back, and people obviously were ticked, right? But, I mean, so it was missed by almost everybody. And I was the only one who caught it just because I was paying attention.
It's crazy.
Right? But I didn't catch it early enough. I should have caught it before. And yeah, I mean, you'd be surprised, man. You'd be surprised.
It seems like the finance sector's like a little bit behind in the tech stuff. Like I know a lot of financial advisors, they're still using like Windows 97 portals and like really old software that's
Yeah,
pretty
I mean,
lame.
yeah, I mean, they're the pragmatists, late adopters, right? There's no incentive to change. It ain't broke, don't fix it.
Yeah,
You know, it's kind of that mentality. They don't need to.
yeah.
They don't need to. Right? People will change when they need to. When they don't, they won't.
Yeah.
You know, and that's kind of it. Like that's the issue I think with the capture things. I'm like, you're solving a problem, but is it a problem people are actually willing to pay for? And pay a lot for? Like you said, it has to be paid a lot to make sense.
Would that
That's
replace
to be seen.
Yeah.
firms like Scalar then?
Interesting.
Or like Greener Equity or whatever?
No, those guys do the valuation work. People pay for that.
Yeah.
But they're doing, you know, they're just calculating each individual deal. So they're taking the articles of incorporation and figuring out, okay, the Series B has a 1x preference, right? They're doing this, they have this kind of model. No, but they don't have to do all the variability in the cap table stuff. They just model one cap table.
Your firm does that as well? Or doesn't do
No,
this?
I don't do that stuff anymore. But Scalar, yeah. Greener Equity carbon copied Scalar, just so you know.
Yeah, no.
Actually, Greener Equity is run by friends of mine who were out of jobs looking for something to do. And I said, go start a valuation company like I did. Really? I'm like, yeah, it'll be fine. We're good.
But did you work at Scalar?
I basically started it. I was
Right.
the only employee. I renamed it. I don't know why we stuck with that dumb name, but it's a mathematical term. You know, scaling, venture, scale. I don't know. So I was like, scale? It's not like it's snakes or something. You know? It's scaly. But yeah, I renamed it, rebranded it, like I restarted the whole company. It used to be a thing called Venture Returns, a little valuation website that was generating no revenue whatsoever. And they brought me in to restart it. I was the only employee with $20,000 in the bank. And had like a handful of customers. I had no idea I was going to pay my salary 60 days. I don't know why I did it. But I did it and made a business out of it. And it was fun. It was an experience. So. Okay. So, the goal here, right, is that eventually we get down to this part right here, total return. So what we're going to do here is take the last liquidation preference plus the last pro rata, and then that is our total returns. See that? So they're getting 10, liquidation preference. They're getting 4.5, liquidation preference, and they're getting their percentage of the 9 million that's left. Bop, 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 that equals the equity value, right? It all checks out. And then from there, we can calculate IRR and returns on investment. What are those zeros? Oh, we know that number. There we go. Okay, but the Series C, we're missing the Series C. Huh?
Let's not worry about it.
Yeah, you guys are good. You guys want to bail? You're good. It's late, huh? I'm gonna stay and crank out the Series C stuff so I can email it out to you guys.
Take
We
that.
can do it fast.
That would be
Yeah.
sweet.
If you want to sit and watch, you're more than welcome.
Yeah.
What a week. Broke my iPhone screen for the first time.
Did you?
Mm.
Yeah, I've had this for like a year and a half, and yeah, I've dropped it multiple times, and yesterday I dropped it. Finally, it cracked, so it's pretty depressing.
You didn't have a screen protector.
No, I used to for a while, but I don't know if that would have even. I don't know. whatevs.